On Friday, February 6, 2026, the global financial system intersected with history. For the first time in its 129-year existence, the Dow Jones Industrial Average breached the 50,000-point threshold. It closed at a record 50,115. But this number is not just a milestone, it is a signal. It represents a massive shift in how the world's largest companies are betting on the future. Welcome back to the AI Operator. I am your host. Today we are dissecting the capital expenditure supercycle, a $650 billion wager by big tech that is reshaping the American economy. While the markets are cheering, the real economy is flashing warning signs. We have a cooling labor market, a fog of war on data, and a massive divergence between those building AI and those paying for it. If you are a business owner or a corporate operator, you need to understand what happened on February 6th. It wasn't just a rally, it was a changing of the guard. Let's break down the new rules. Section 1, the anatomy of the rally. The trading session of February 6th will be recorded in history books. But the path to 50,000 wasn't a straight line. The week prior saw unhinged volatility, driven by fears that agentic AI would cannibalize software companies and that Bitcoin was collapsing. The sentiment was shifting fast. Yet on Friday, the market reversed. The Dow surged 1,207 points, and unlike previous rallies, this one was broad, a sign that confidence was returning to more than just a few tech giants. 27 of the 30 Dow components were green. The Russell 2000 jumped 3.6%. This tells us the market is betting on a soft landing. But beneath this euphoria, there was a ruthless logic at play. The market decided that Amazon's expense is Nvidia's revenue. When Amazon announced massive spending, its stock dropped 8%. Meanwhile, Nvidia and Broadcom, selling the chips, soared nearly 8%. Investors love the toll collectors of the AI age, but they are terrified of the companies footing the bill. This highlights the risk for the giants who are pouring billions into the void. Section 2, the capital expenditure supercycle. Let's talk about that bill. The single most important number for 2026 is $650 billion. That is the combined projected spend. This is the combined projected capital expenditure for Amazon, Alphabet, Meta, and Microsoft this year alone. It is a barrier to entry so high that it effectively ends competition for the intelligence layer. Amazon alone announced a plan to spend approximately $200 billion in 2026. This exceeded Wall Street estimates by $50 billion. It's a staggering commitment to new infrastructure. Where is this money going? It is going to the AI grid, data centers, power plants, and custom silicon. This is the physical foundation being built for the next century of computing. Amazon is building Project Rainier, a cluster of over 500,000 Trainium2 chips. This is not just a server farm. It's a supercomputing engine designed for the age of agentic AI. CEO Andy Jassy defended this by saying, "All new AWS capacity sells out immediately." This demand is the fuel for their massive investment, proving the need for this intelligence layer. For you, the operator, the signal is clear. They are building the railroads. You need to be ready to run your trains on them. This is the infrastructure you will depend on. Even if this is a bubble for investors, the infrastructure gets built. It will be the substrate of your business for the next decade. Be ready for the 2026 economy. Section 3. The semiconductor hegemony. While the hyperscalers sweat over margins, the chip makers are enjoying the greatest sellers market in history. Nvidia rose 7.9% and Broadcom rose 7.1%. Why? Because as AI clusters grow to 500,000 chips, the bottleneck shifts from computing to connecting. Broadcom's networking gear is essential. But Amazon is fighting back. Their push into Trainium chips is an attempt to break the Nvidia tax. By manufacturing their own silicon, Amazon hopes to lower the cost of running models. If they succeed, the cost of inference drops. For the solopreneur, this is the holy grail. We need the cost of using AI agents to hit zero. Section 4. The macroeconomic divergence. Now we must leave the stock market and look at the real economy. While the Dow hits 50,000, the streets tell a different story. We are operating in a fog of war. The government shutdown in late 2025 created a massive data blackout, leading to discrepancies of up to 100,000 jobs between private and public data. But the trend is clear. The labor market is cooling. The US economy added only 50,000 jobs in December 2025. Job openings have collapsed to 6.5 million, the lowest since the pandemic. We have shifted from the Great Resignation to the Great Freeze. Companies are hoarding labor to avoid rehiring costs, but they are absolutely not hiring new staff. What does this mean for the operator? It means leverage has returned to the employer, but do not fall into the trap of hiring just because it's easier. This freeze is your window to automate. The big corporations are freezing hiring to digest their AI investments. You should be doing the same. Replace the open headcount with systems. Do not hire a human for a role an agentic AI can do in 18 months. The consumer is also exhausted. The vibe session persists, with sentiment at a dismal 57.3. The wealth effect is bifurcated. Stock owners feel rich, wage earners feel the squeeze. Expect the consumer to be picky. Your business needs to use AI to drive deflationary pricing power. Cut your costs, lower your prices, and steal market share.
Section 5. The Fed, the Hawkish Pause, and Mr. Tariff. The Federal Reserve is in a bind. In January, they held rates steady at 3.5% to 3.75%. This hawkish pause signals worry about inflation reigniting. Why? Because of the political landscape. The Trump administration's return has brought Mr. Tariff back. Tariffs are at their highest level since 1935. Normally, this kills markets. But the market is betting on the taco trade, assuming the president will dilute the tariffs to protect stocks. We also have the promise of fiscal stimulus, the One Big Beautiful Bill Act. The administration wants to run the economy hot for the 2026 midterms. But the risk is overheating. If they stimulate a constrained economy, inflation returns. If inflation returns, the Fed keeps rates high. And if rates stay high, capital remains expensive for your business. Section 6. Are we in a bubble? With the Dow at 50,000, are we repeating the year 2000? The Magnificent Seven are trading at 26 times earnings. High, but not the 100 times earnings of the dot-com crash. These companies are cash-printing machines. However, the software sector is being liquidated. Investors are terrified that AI agents will destroy the seat-based license model of companies like Salesforce. This is a critical insight for the operator. The stock market is saying software as a service is dying. Do not build your business on selling quote-unquote seats. Build it on selling quote-unquote outcomes. The market punishes tools and rewards results.
Conclusion and strategic outlook. So where do we stand? The Dow at 50,000 is a show-me moment. The price has arrived before the full productivity. The market has priced in the AI revolution, but it hasn't fully hit the P&L statements of non-tech companies yet. For the next week, all eyes are on the delayed jobs report and CPI data. Volatility will remain the norm. Here is your operational blueprint for the 2026 chaos. We need to be surgical in our approach to this new landscape. 1. Respect the CapEx. Amazon is spending $200 billion to make compute abundant. This is a staggering level of investment. Plan your business, assuming intelligence will be cheap. The cost of cognitive labor is trending towards zero. 2. Beware the labor trap. The labor market is cooling significantly. Do not bloat your payroll with roles that machines can do. Use the hiring freeze as an opportunity to automate. Systems are more scalable than staff in this environment. 3. Watch the rates. If the Fed doesn't cut in March, capital gets expensive. The window of opportunity for cheap debt is closing. Cash flow is king. Liquidity will define who survives the next volatility spike and who gets liquidated. 4. Pivot from SaaS. The era of simple tools is over. If you are building tech, build agents, not tools. Individual software is dead. The 50,000 threshold is breached. The supercycle is here. The giants are fighting a war of attrition with hundreds of billions of dollars. Your job is not to fight them. Your job is to operate in the ecosystem they are building, faster, leaner, and smarter than they can. This is the AI operator, replacing staff with systems, building the enterprise of tomorrow today. I'll see you in the next briefing.